This is the most difficult part of the economic cycle.
The rate hikes are being underestimated.
The market wants revenue growth, not just cost-cutting stories. It's been 10 stocks.
The key is going to be what happens to the consumer.
Hard landing?
I'm not getting that sign of economic reacceleration.
So are you long Apple?
Obviously, because it's such a big part of the index. But Apple's another category of stock where people are paying up for the quality of the balance sheet, the lack of need for financing. The higher quality banks are outperforming the lower quality banks. Even though the S&P is outperformed, it's been 10 stocks. That's idiosyncratic. The market's paying up for what I would call operational efficiency, cost leaders. It's paying up for good balance sheets. It's paying up for scale. Will that change? Can we broaden out to the lower end of the market? If the market starts to believe that not only do we avoid a recession, but there's a reacceleration, that's what we need to see. That's what the market's trying to figure out. Hard landing, reacceleration. This purgatory land is we're just going to kind of slop back and forth, and the market's going to continue to gravitate to the lifeboats. Obviously, the market this year has voted with its feet saying they want to buy large cap growth stocks, not just tech, but growth stocks with good balance sheets that have scale. And I want to point something out that's really important for these 7 or 8 stocks this year. Most of the earnings recovery for these stocks has been a result of cost cutting. They all got over their skis on too much spending last year. They reined that in, and so they've kind of manufactured an earnings recovery. If they don't see top line reacceleration, this is where we're starting to see a separation now, even in those 7. And I think that's going to be another story for the fourth quarter and next year's. The market wants revenue growth, not just cost-cutting stories. This is the most difficult part of the economic cycle. We know we're late cycle for one reason, because we got full employment. So you can't argue we're mid-cycle or early cycle. That's silly. What you can argue is that the late cycle period can persist for a lot longer than people expected, and that's what's going on. Rates have really surprised everybody, bond investors and stock investors. Normally in the late cycle environment, rates come down. Why? Because the Fed's done. As you know, this cycle is unique. That's the tricky part of this cycle, because the Fed can't be proactive in cutting rates ahead of the recession. So we're just going to ride this until basically you run out of gas. And that could be another year. We don't know the answer to that yet.
There are lags that we all know, long and variable policy lags. When you look historically, from the time of the first rate hike by the Fed to the time the recession starts, it's typically 2 years. The people that were jumping the gun calling for recession this year were just basically a little too impatient. Reminds me of the recession calls I was making in 2007. That was a very long, soft landing, but the recession started December of 2007. We just have to basically acknowledge that this year the economy did better than expected for 2 reasons. We had the lingering impact of the fiscal stimulus, and we had a consumer credit card boom. Those are not recurring. So it's going to be interesting to see, with the credit card issuance coming down and fiscal tailwinds moving to headwinds, how the consumer is going to be responding starting in the fourth quarter.
We're also ramping up on infrastructure spending and the CHIPS Act and the Inflation Reduction Act. All of that money is going to come in next year and offset a potential recession.
No, I don't think that's going to happen. I think that when you're taking a look at the fiscal deficit to GDP ratio, the big stimulus was actually this year. The incremental impact on growth was this year, not next year. I don't know why you would be comparing industrial subsidies, which is a relatively small share of GDP, to the impact of the consumer sector, which is 70% of GDP. You can't compare the two. The key is not how the CHIPS Act or all these other industrial subsidies, government intervention is going to influence the business cycle. The key is going to be what happens to the consumer now that these fiscal training wheels are off. The lagged impact of the rate hikes, I think, are being underestimated by the Fed and by most of the people you interview from Wall Street. The shift from fiscal tailwinds to headwinds for the consumer, which is 70% of GDP, Sarah, what you're focusing on in the business sector is a small share of GDP. It's a small contribution, but I think the overwhelming impact is going to be the pullback that we'll see in the consumer sector over the course of the next several months. We just got housing starts. For the month of August, they were down 11%. We got new home sales. What was that? Yesterday, down 9%. Existing home sales were down. In inflation, actually in August, real disposable income was down. So I'm not getting that sign of economic reacceleration unless your only metric is the Atlanta Fed's nowcast model. Everything else is showing that the economy is actually trudging along somewhere close to a 2% annual rate. But don't forget, we've been breathing fumes of the lingering impact of the fiscal stimulus all year long. That's coming to an end right now. So I don't know where the reacceleration is coming from, unless you believe somehow that interest rates don't matter.
It's just
and
a
if you
good
believe
jobs
that
market.
policy lags don't exist,